Good evening, ladies and gentlemen, and continuing from part 1, we're in part 2 now in our Forex Trading Beginners class. So today or now we're going to look at how to trade Forex. So topic is how do we trade Forex, and on this part we're going to look at how to make money trading Forex. So what is Forex trading? And we're going to look at how does Forex trading work. In the Forex market, you buy or sell currencies. Placing a trade in the Forex exchange market is simple. The mechanics of a trade are very similar to those found in other financial markets, like the stock market. So, if you have any experience in trading, you should be able to pick up pretty quickly. And if you don't, you'll still be able to pick up as long as you finish School of Physiology, our Forex trading course. The objective of Forex trading is to exchange one currency for another in the expectation that the price will change. More specifically, that the currency you bought will increase the value compared to the one you sold. Here's an example. So, trader's action: you purchased 1,000 euros at the Euro USD exchange rate of 1.1800. So, your euro you bought is 1,000. And your USD is 1,180. Now, how did you get that US dollar of minus 1,180? That is a euro of 1,000 times the exchange rate, which is 1.18, which will now give you 1,180. So 2 weeks later, you exchange your 1,000 euros back into US dollar at the exchange rate of 1.2500. So now you've lost a 1,000 euro, but you've gained 1,250 euros. Now, how did we get that? $1,250, sorry. How did we get that $1,250? We now also did that euro of 1,000 times 1.25, which will give us our $1,250. So you earn the profit of $700. So that's how it happened there. Now let's move on. An exchange rate is simply the ratio of one currency valued against another currency. For example, the US dollar Swiss franc exchange rate indicates how many US dollars can purchase one Swiss franc, or how many Swiss francs you need to buy one US dollar. Now, how to read the Forex quotes. Currencies are always quoted in pairs, such as the British pound US dollar or US dollar Japanese yen. The reason they are quoted in pairs is that in every foreign exchange transaction, you are simultaneously buying one currency and selling another. So how do you know which currency you are buying and which you are selling? Excellent question. This is where the concept of base and quote currencies come in. So base and quote currency. Whenever you have an open position in Forex trading, you are exchanging one currency for another. Currencies are quoted in relation to other currencies. Here is an example of a foreign exchange rate of the British pound versus the United States dollars. So British pound, US dollar, and the exchange is 1.21288. This image here, this is what it is. So we're saying that you need $1.2188 to buy one British pound. That's what it just means here. And the British pound, the one before the slash, is your base currency, while the one after is your quote currency. In any currency pair, just know the first 3 letters are for your base currency and the last 3 letters are for your quote currency. The first listed currency to the left of the slash is known as the base currency, in this example the British pound. The base currency is the reference element for the exchange rates of the currency pair. It always has a value of 1. The second listed currency on the right is called the counter or quote currency. In this example, the US dollar. When buying, the exchange rate tells you how much you have to pay in units of the quote currency to buy 1 unit of the base currency. In the example above, you have to pay 1.21228 US dollars to buy 1 British pound. Now, when selling, the exchange rate tells you how much units of the quote currency you get for selling 1 unit of the base currency. In the example above, you will receive 1.21228 US dollars when you sell 1 British pound. The base currency represents how much of the quote currency is needed for you to get 1 unit of the base currency. If you buy Euro USD, this simply means you are buying the base currency and simultaneously selling the quote currency. In caveman talk, buy Euro, sell US dollar. 1. You would buy the pair if you believe the base currency will appreciate, which means you believe the base currency will gain value relative to the quote currency. That is when you buy the pair. Again, you will buy the pair if you believe the base currency will appreciate relative to the quote currency. 2. You will sell the pair if you think the base currency will depreciate. That means the base currency will lose value relative to the quote currency. With so many currency pairs to trade, how do forex brokers know which currency to list as the base currency and the quote currency? Fortunately, the way that currency pairs are quoted in the forex market is standardized. You may have noticed that currencies quoted as a currency pair are usually separated with a slash or a slash character. Just note that this is a matter of preference, and the slash may be omitted or replaced by a period, a dash, or nothing at all. For example, some traders may type Euro USD with a slash in the middle as Euro dash US dollar or just Euro USD. They all mean the same thing. So the next step is long and short. First, you should determine whether you want to buy or sell. If you want to buy, which actually means buy the base currency and sell the quote currency, you want the base currency to rise in value, and then you will sell it back at a higher price. In trader talk, this is called going long or taking a long position. Just remember, long equals buy. If you want to sell, which actually means sell the base currency and buy the quote currency, you want the base currency to fall in value, and then you would buy it back at a lower price. This is called going short or taking a short position. Just remember, short equals sell. Now, flat or square. If you have no open position, then you are said to be flat or square. Closing its position is also called squaring up. The bid, ask and spread. All forex quotes are quoted with two prices, the bid and ask. In general, the bid is lower than the ask price. Here you can see your bid and ask price. This is just a simplified chart of Euro US dollar, and your bid price, which is always lower than your ask price, is the sell price, while your ask price is the price you buy the pair. Now you can see there's a 2.0 in between the two units there. That's what we call spread. So let's go on. I'll explain everything to you. So 1, what is bid? Bid is the price at which your broker is willing to buy the base currency in exchange for the quoted currency. This means the bid is the best available price at which you, the trader, can sell to the market. If you want to sell something, the broker will buy it from you at the bid price. So what is ask? The ask is the price at which your broker will sell the base currency in exchange for the quote currency. This means the ask price is the best available price at which you can buy from the market. Another word for ask is the offer price. If you want to buy something, the broker will sell or offer it to you at the ask price. 3. What is spread? The difference between the bid and the ask price is known as the spread. On the Euro US dollar quote above, the bid price is 1.34568 and the ask price is 1.34588. Look at how this broker makes it so easy for you to trade away your money. If you want to sell euro, you click sell and you sell euros at 1.34568. If you want to buy euro, you click buy and you buy euros at 1.34588. So here's an illustration that puts together everything you've covered in this lesson. Base currency and your counter currency. Your base currency is the euro, while the counter currency or quote currency is the US dollar here. Also, the first amount there, the 1.1051, is your bid price, while your 1.1053 is your ask price, and the spread between these two, the bid price and the ask price, is 2. Now that last digit there, the fourth digit after the decimal place, is what we call the pip. Now you can see how we got the spread. We did 1.1053, which is our ask price, minus the 1.1051, which is our bid price, which gave us just 2 pips. So now let's take a look at some examples. Know when to buy or sell a currency pair. Forex trading involves trying to predict which currency will rise or fall versus another currency. So how do you know when to buy or sell a currency pair? In the following examples, we are going to use a little fundamental analysis to help us decide whether to buy or sell a specific currency pair. The supply and demand for a currency changes due to various economic factors, which drives currency exchange rates up and down. Each currency belongs to a country or region, so Forex fundamental analysis focuses on the overall state of the country's economy, such as productivity, employment, manufacturing, international trades, and interest rates. So wake up. If you always fall asleep during economic classes or just flat out skip economic classes, don't worry. We will cover fundamental analysis in a later lesson, but right now, try to pretend you know what's going on. So, example using Euro US dollar. In this example, the euro is the base currency, thus the basis for the buy and sell. If you believe that the United States economy will continue to weaken, which is bad for the US dollar, you will execute a buy Euro US dollar order. By doing so, you have bought euros with the expectation that it will rise versus the US dollar. So if you believe the US economy is strong and the euro will weaken against the US dollar, you execute a sell Euro US dollar order. By doing so, you have sold euros with the expectation that it will fall versus the US dollar. Now, next currency example, US dollar, Japanese yen. In this example, the United States dollar is the base currency and thus the basis for the buy and sell. If you think that the Japanese government is going to weaken the yen in order to help its export industry, you execute a buy US dollar, Japanese yen order. By doing so, you have bought US dollars with the expectation that it will rise versus the Japanese yen. If you believe that the Japanese investors are pulling money out of the United financial markets and converting all their US dollars back to yen, this will hurt the US dollar. You will execute a sell US dollar, Japanese yen order. By doing so, you have sold United States dollars with the expectation that it will depreciate against the Japanese yen. Another example of currency pairs, the Great British Pound versus the United States dollars. In this example, the pound is the base currency and thus the basis for the buy or sell. If you think the British economy will continue to do better than the United States in terms of economic growth, you execute a buy Great British Pound US dollar order. By doing so, you have bought pounds with the expectation that it will rise versus the United States dollar. Now, if you believe the British economy is slowing while the American economy remains strong like Chuck Norris, you execute a sell Great British Pound US dollar order. By doing so, you have sold pounds with the expectation that it will depreciate against the United States dollar. So, now, how to trade Forex with United States dollar Swiss franc? Again, in this example, the US dollar is the base currency and thus the basis for the buy or sell. If you think the Swiss franc is overvalued, you will execute a buy US dollar Swiss franc order. By doing so, you have bought US dollars in the expectation that it will appreciate versus the Swiss franc. If you believe that the US housing market weakness will hurt future economic growth, which will weaken the dollar, you would execute a sell US dollar Swiss franc order. By doing so, you have sold US dollars with the expectation it will depreciate against the Swiss franc. Now, trading in lots. When you go to a grocery store and you want to buy an egg, mostly you can't just buy a single egg. They come in dozens or lots of 12. In Forex, it would be just as foolish to buy or sell €1. So they usually come in lots of 1,000 units of currency, which is a micro lot, 10,000 units of the currency, which is a mini lot, or 100,000 units of the currency, which is a standard lot, depending on your broker and the type of account you have. More on lots later. Now, margin trading. But I don't have enough money to buy 10,000 euros. Can I still trade? You can, by using what we call leverage. When you trade with leverage, you wouldn't need to pay the 10,000 euros upfront. Instead, you put down a small deposit known as margin. Leverage is a ratio of the transaction size, which we call position size, to the actual cash, which is the trading capital, used for margin. For example, a 50-to-1 leverage, also known as a 2% margin requirement, means $2,000 of margin is required to open a position size worth $100,000. Or better still, you can say $2 is needed to open a position size of $100. Trading margin lets you open a large position sizes or large position sizes using only a fraction of the capital you would normally need. This is how you're able to open 1,250 or $50,000 positions with as little as $25 or $1,000. You can conduct relatively large transactions with a small amount of initial capital. So let us explain. We'll be discussing margin in more detail later, but hopefully you'll be able to get a basic idea of how it works. Listen carefully, because this is very important. 1. You believe that signals in the markets are indicating that the British pound will go up against the US dollar. You open one standard lot, which is 100 units of Great British Pound US dollar, and you buy with the British pound with a 2% margin requirement. You wait for the exchange rate to climb. When you buy one lot, which is one standard lot, which we call 100,000 units of Great British Pound US dollar, at a price of 1.50000, you are buying 100,000 pounds, which is now worth $150,000, and this is gotten by multiplying your 100 units of British pound times the exchange rate, which is a 1.50000. Since the margin requirement was 2%, then US dollar 3,000 will be set aside in your account to open the trade, and we did this by doing $1,500 times 2%, which now give us your $3,000. So 2% of 150,000 is just 3,000. You now control £100,000 with just $3,000. Your prediction come true and you decide to sell. You close the position at 1.50500. You earn about $500. So this is how your action will look like in this chart here. So your action was you buy 100,000 units of pounds at the exchange rate of 1.50000. So you had in your a order of accepting 100,000 British pounds and paying 150,000 US dollars. Now you take a nap for 20 minutes and the Great British Pound US dollar exchange rate rises to 1.5050, and now you sell, which means you close your position. So now since you've sold, you now lose that your 1,000 Great British Pounds, but you also gain, that's you now receive back that your money you initially gave, which is your $150,500. Now if you do your calculation and from everything, plus 100,000 British pound minus 100,000 British pound, you have zero. Then minus 150,000 US dollars plus $150,500 will now give you your $500. So you have to earn a profit of $500. When you decide to close the position, the deposit, that's your margin that you originally made, your 2% deposit, your 2% margin, is returned to you, and the calculation of your profit or losses is also done. This profit or loss is then credited to your account. Now, let's review the Great British Pound US dollar trade example above. 1. Great British Pound US dollar went up by a mere half a pence, not even 1 pence, it was half a pence. 2. But you made $500. 3. While taking a power nap. 4. How? Because you weren't trading just £1. 5. If your position size was just 1 pass, yes, you would have made only half a pence, but your position size was £100,000 or $150,000 when you opened the trade. That was your position size. 7. What's neat is that you didn't have to put up that entire amount. 8. All that was required to open the trade was a $3,000 in margin. 9. $500 profit from $3,000 capital is a 16.67% return. 10. In just 20 minutes. 11. That's the power of leverage trading. A small margin deposit can lead to large losses as well as gains. It also means that a relatively small movement can lead to a proportionally much larger movement in the size of your loss or profit, which can work against you as well as for you. You could have easily lost $500 in 20 minutes as well. You wouldn't have woken up from a nightmare. You would have woken up into a nightmare. High leverage sounds awesome, but it can be deadly. For example, you open a Forex trading account with a small deposit of $1,000. Your broker offers a 100-to-1 leverage, so you open a $100,000 Euro USD position. A move of just 100 pips will bring your account to zero. A 100 pip move is equivalent to just £1. You blew your account with a price move of a single euro. Congrats. Now rollover. For positions open at your broker's cut-off time, which is usually 5 p.m. Eastern time. You have to know your GMT, your EMT, and your BST, all your normal times. Again, let me start. For positions at your broker's cut-off time, usually 5 p.m. ET, there is a daily rollover fee, also known as a swap fee. that a trader either pays or earns depending on the positions you have open. Now, ET means instant time or instant time, but it's instant time. If you do not want to earn or pay interest on your position, simply make sure they are all closed before 5 p.m. ET, the established end of the market day. Now, this is where you have to do your own calculation yourself. I'm going to leave this for you to start testing your knowledge so you know how to calculate for GMT and the rest of the other times. Convert your 5 p.m. ET to GMT, then you can tell me what it gives you. Now, let's proceed. Since every currency trade involves borrowing one currency to buy another, interest rollover changes or charges are part of forex trading. Interest is paid on the currency that is borrowed. Interest is earned on the one that is bought. If you are buying a currency with a higher interest rate than the one you are borrowing, then the net interest rate differential will be positive. For example, US dollar Japanese yen, and you earn interest as a result. Conversely, if the interest rate differential is negative, then you will have to pay. Note that many retail brokers do adjust their rollover rates based on different factors, which is example, account leverage, interbank lending rates, and some other things. Please check with your broker for more information on the specific rollover rates and crediting debiting procedures. So here is an example, or here's a table to help you figure out the interest rate differential of the major currencies. So benchmark interest rates. United States dollars. In United States, their interest rate is less than 0.25%. Euro, their interest rate is 0.00%. United Kingdom, interest rate is 0.10%. Japan, the interest rate is minus 0.10%. Canada, the interest is 0.25%. Australia, the interest rate is 0.25%. New Zealand, the same thing, 0.25%. And Switzerland, the interest rate is minus 0.75%. Now, later on, we'll teach you all about how you can use interest rate differentials to your advantage. So when trading on margin, it's important to be aware that your risk is based on the full value of your position size. You can quickly blow your account if you don't understand how margin works. We want you to avoid this. Due to this danger, we dedicate an entire section on how margin trading works, called Margin Trading 101. So, next topic, what is Pip in Forex? Here is where you are going to do a little math, just a little bit. You've probably heard of the term pips, points, pipettes, and lots thrown around, and now we're going to explain what they are and show you how their values can be calculated. Take your time with this information as it is required knowledge for all forex traders. Don't even think about trading until you are comfortable with pip values and calculating profit and losses. What the heck is a pip? The unit of measurement to express the change in value between two currencies is called a pip. If Euro US dollar moves from 1.1050 to 1.1051, that 0.0001 US dollar rise is valued as 1 pip. A pip is usually the last decimal place of a price quote. Most pairs go out to 4 decimal places, but there are some exceptions like Japanese yen pairs that they go out to 2 decimal places. For example, for Euro US dollar, it is 0.0001, and for US dollar Japanese yen, it is 0.01. So here is the diagrammatic explanation of what a pip is. That last decimal place is just a pip. So this is it. So what is a pipette? There are forex brokers that quote currency pairs beyond the standard 4 or 2 decimal places to 5 or 3 decimal places. They are quoting fractional pips, also called points or pipettes. If the concept of pip isn't already confusing enough for the new forex trader, let's try to make you even more confused and point out that a point or pipette or fractional pip is equal to a tenth of a pip. For instance, if Great British Pound US dollar moves from 1.30542 to 1.30543, that 0.00001 US dollar move higher is 1 pipette. So this is a graphical example of what a pipette is. The 5th decimal place here in this pair, Great British Pound US dollar pair. So here's how fractional pips look like on a trading platform. So you can see that it's a floating one, or it has a different hue, or you see it truncate. They will signify it for you, depends on your broker. But this is how it looks like to you. As you can see, we have a Euro US dollar currency pair, and we'll have a bid price of 1.36211 and an ask price of 1.36228. You can see your fractional pipette there. So from this, I believe you guys should be able to calculate your spread in pips and pipettes, and you'll be able to tell me the answer too. I'm expecting 2 answers now. I've asked you 2 questions. If you don't know the first question, please go back and watch the video again so you find out where the first question was, because you're going to provide the answers for me. On trading platform, the digits representing a tenth of a pip usually appears to the right of the 2 larger digits. Excuse me. Here's a pip map to help you learn how to read pips. So we have a currency of 1.15382. Now we're going to start from the right hand side, moving down to the left. So we're starting from the 5th digit after the decimal point. That's what it means. So the 2 in gray is 0.2 pips. Remember, I'll say pipette is 1/10 of a pip. So this 2, the 5th decimal place there, the 5th digit after decimal place is your 0.2 pips or 2 pipettes. Next is the 8, which is actually 2 pips. Then the 3 is 30 pips. The 5 is 500 pips. The 1 is 1000 pips. That's the 0.1 is 1000 pips. And the 1 before the decimal place is the 10,000 pips. How to calculate the value of a pip? As each currency has its own relative value, it's necessary to calculate the value of a pip for that particular currency pair. In the following example, we will use a quote with 4 decimal places. For the purpose of better explaining the calculation, exchange rates will be expressed as a ratio. That is, Euro USD at 1.2500 will be written as 1 euro represent 1.2500 US dollars. So example number 1, US dollar Canadian dollar with exchange rate of 1.0200. It will be read as 1 US dollar to 1.0200 Canadian dollar, or 1 US dollar slash 1.0200 Canadian dollar. The value change in counter currency times the exchange rate ratio equals pip value in terms of BIP currency. So this is what I meant above. So the value change is the 0.0001 Canadian dollar times 1 US dollar slash 1.0200 Canadian dollar, or simply as 0.0001 Canadian dollar divided by 1.0200 Canadian dollar. Now the Canadian dollar will cancel at each other. Then times 1 US dollar, it will now give you 0.00009804 US dollar per unit traded. Using this example, if we traded 10,000 units of US dollar Canadian dollar, that is using our mini lot size, then a 1 pip change to the exchange rate will be approximately at 0.98 US dollar change in the position value, and this is gotten by multiplying your unit size, which is a 10,000 unit, your mini lot size, times our units per trade, which is 0.00009848 United States dollar per unit. We say approximate because as the exchange rate changes, so does the value of each pip move. Example number 2. Great British Pound versus the Japanese yen at the exchange rate of 123.00 Japanese yen. So here's another example using a currency pair with the Japanese yen as the counter currency. Notice that this currency pair only goes to 2 decimal places to measure a 1 pip change in value. Most of the other currencies have 4 decimal places. In this case, a 1 pip move would be 0.01 Japanese yen. Now, again, to calculate it, we'll now do the value change in counter currency, which is 0.01 Japanese yen, times the exchange rate ratio, which is the ratio is the 1 British pound to 123 Japanese yen, to now give us our p value. So now let's do the mathematics so you can see. We now have the 0.01 Japanese yen divided by 123 Japanese yen. The Japanese yen will cancel out each other, times 1 British pound, to now give us 0.000813 Great British Pound. Again, I want to use this example with our mini lot size. So when trading a 10,000 units, which is also called the mini lot size of Great British Pound Japanese yen, each pip change in value is worth approximately 0.813 Great British Pound, and that is done by times 10,000 units. Excuse me. Let me not make a mistake. Just hold on, please. So that is done by calculating a 10,000 units. Although I didn't calculate it here, but I believe you can get it. You're doing your 10,000 units times 0.000813 will now give you our answer of 0.813 Great British Pound. Let's proceed. Now, how to find the p value in your trading account currency? Okay, I did it here, remember, but I broke it down so you can understand. So that's why I got a little confused. The final question to ask when figuring out the pip value for your position is, what is the pip value in terms of my trading account's currency? After all, it is a global market and not everyone has the account denominated in the same currency. This means that the pip value will have to be translated to whatever currency our account may be traded in. This calculation is probably the easiest of all. Simply multiply or divide the found pip value by the exchange rate of your account currency and the currency in question. If the found pip value currency is the same currency as the base currency in the exchange rate quote. So now, using this example of Great British Pound Japanese yen, let's convert the found pip value of our 0.813 British Pound to the pip value of US dollar by using Great British Pound US dollar exchange rate at 1.5590 as our exchange rate ratio. If the currency you are converting to is the counter currency of the exchange rate, all you have to do is divide the found p-value by the corresponding exchange rate ratio. In this sense, we now have our 0.813 Great British Pound per pip. We're now divided by our ratio of 1 British Pound is equal to 1.5590 US dollar. Or again, do 0.813 Great British Pound divided by 1 British Pound. They'll cancel out each other. That's the British Pound value. That will now give us our 0.813 times 1.5590 US dollar, which will give us 1.2674 US dollar per pip move. So far, for every 0.01 pip move in Great British Pound versus Japanese yen pair, the value of a 10,000 mini lot size position changes by approximately 1.27 United States dollar. If the currency you are converting to is the base currency of the conversion exchange rate ratio, then multiply the found pip value by the conversion exchange rate ratio. Now, using our United States dollar Canadian dollar example above, we want to find the pip value of 0.98 US dollar in New Zealand dollars. We will use 0.7900 as our conversion exchange rate. Now, 0.98 US dollar per pip times 1 New Zealand dollar, which is equivalent to 0.7900 United States dollar, or 0.98 US dollar divided by 0.7900 US dollar. The US dollar cancels out itself times 1 New Zealand dollar, which will now give us 1.2405 New Zealand dollar per pip move. So for every 0.001 pip move in United States dollar Canadian dollar from the example above, your 10,000 units position size or your mini lot size changes in value by approximately 1.24 New Zealand dollar. Even though you are now a mad genius, at least with pip values, you're probably rolling your eyes back and thinking, do I really need to work out? Do I need to work all this out? Well, the answer is a big fat no. Nearly all forex brokers will work all this out for you automatically, but it's always good for you to know how they work it out. If your broker doesn't happen to do this, don't worry. You can always download a pip value calculator. I won't do some. In the next lesson, we will discuss how these seemingly insignificant amounts can add up. So next is, what is a lot in Forex? Forex is commonly traded in specific amounts or called lots, or basically the number of currency units you will buy or sell. A lot is a unit measuring a transaction amount. When you place orders on your trading platform, orders are placed in sizes quoted in lots. It's like an egg carton or egg box in British English. When you buy eggs, you usually buy a carton or box. One carton includes 12 eggs. The standard size of a lot is 100,000 units of a currency. And now, there is also mini, micro, and nano lot sizes that are 10,000, 1,000, and 100 units respectively. So here is a table to show you the breakdown of your lot size. Some brokers show quantity in lots, while other brokers show the actual currency unit. As you may already know, the change in a currency value relative to another is measured in pips, which is very, very small percentage of a unit's currency value. To take advantage of this minute change in value, you need to trade large amounts of a particular currency in order to see any significant profit or loss. Let's assume we are using 100 units, that is a standard lot size. You will now recalculate some examples to see how it affects the pip value. From our first example, using From one of our first example, using the United States dollar Japanese yen at an exchange rate of 119.80, our calculation will now give us, for 1 pip, which is our 0.01, divided by 1198 times 100,000 units, will now give us $8.34 per pip move. Also, for United States dollars Swiss franc at an exchange rate of 1.4555, our 1 pip move, which is our 0.0001, divided by the exchange rate, which is 1.4555, times our unit size, which is 100,000 units or standard lot size, will now give us $6.87 per pip move. In cases where the United States dollar is not quoted first, the formula is slightly different. In this case, you can see now the US dollar is now the counter currency or quote currency, not the base currency like we did in the first 1 and 2, US dollar Japanese yen pair and US dollar Swiss franc pair. So this is how to calculate it. 1 euro US dollar at an exchange rate of 1.1930. Again, 0.001 pip movement for you for this is now divided by 1.1930 times your 100,000 units, which is your standard lotted, will now be equals to 8.38 times 1.193, which will now be equals to $9.99734, rounded up to about $10 per pip. Great British Pound versus United States dollars. At an exchange rate of 1.8040. Again, 1 pip side, which is 0.0001, divided by our exchange rate, which is 1.8048, times 100,000 units. That's our standard loss. I will now be equals to 5.54 divided by or times 1.8040, which will now give us 9.99418, rounded up to about $10 per pip. So here are the examples of pip values of euro US dollar and US dollar Japanese yen, depending on your lot size. So this table just shows it. Please mind the way it's arranged. Just pay attention to it carefully and understand it. So let's start with the euro US dollar. You can see any closing price, doesn't matter the closing size. Your unit is now 0.0001. Imagine there are 4 decimal places because this unit is not 2 decimal places, it's up to 4 decimal places. So for one standard lot size, a 1 pip move is about $10. For mini lot size, 1 pip move is about $1. For micro lot size, 1 pip move is about $0.1. And nano lot size, 1 pip move is $0.01. The next pair of Japanese US dollar Japanese yen, 1 US dollar is equals to 80 Japanese yen. Example, just giving it. Our unit is now 0.000125. And now for standard lots, 1 pip movement is equals to 12.5 US dollars. 1 pip movement in the mini lot is 1.25. 1 pip movement for micro lot is 0.125, and 1 pip movement for a nano lot size is 0.0125. Your broker may have a different convention for calculating pip values relative to lot size, but whatever way they do it, they'll be able to tell you what the pip value is for the currency you are trading at that particular time. In other words, they do all the mathematical calculations for you. As the market moves, so will the pip value depending on your currency you are currently trading. So what the heck is leverage? You're probably wondering how a small investor like yourself can trade such large amount of money. So this is a chart to show you what leverage is all about. You can see a standard lot size. You have one lot, we call it one lot. That's 100,000 units. Your mini lot size, we call it a 0.1 lot of 10,000 units. Your micro lot size is 0.01 lots of 1,000 units. And your nano lot size is 0.001 lots of 100 units. And you can see that's just explanation here. The standard lots represent $10 a pip when using Euro US dollar as a base currency. A mini lot represents $1 a pip when using Euro US dollar as a base currency. Also, a micro lot represents 0.10 when using US dollar. And your nano lot also, you can do that. It now gives 0.01 a pip. That is it also. Think of your broker as a bank who basically fronts you $100,000 to buy currencies. All your bank asks from you is that you give it $1,000 as a good faith deposit, which it will hold for you but not necessarily keep. Sounds too good to be true. This is how Forex trading using leverage works. The amount of leverage you use will depend on your broker and what you feel comfortable with. Typically, the broker will require a deposit, also known as margin. Once you have deposited your money, you will then be able to trade. The broker will also specify how much margin is required per position or lot traded. For example, if the allowed leverage is 100 to 1 or 1% of position required, you will need to trade a position worth 100,000 but only having $5,000 in your account. No problem, as your broker will set aside $1,000 as a deposit and let you borrow the rest. Again, for example, if the allowed leverage is 100,000 to 1 or 100 to 1 or 1% of position required, and you wanted to trade the position worth 100,000 but you only have 5,000 in your account, no problem, as the broker will only set aside 1,000 as a deposit and let you borrow the rest. Of course, any losses or gains will be deducted or added to the remaining cash balance in your account. The minimum security, which is margin, for each lot will vary from broker to broker. In the example above, the broker required a 1% margin. This means that for every $100,000 traded, the broker wants $1,000 as a deposit on the position. Let's say you want to buy one standard lot, which is 100,000 units of US dollar Japanese yen. If your account is allowed 100 to 1 leverage, you have to put up $1,000 as a margin. The $1,000 is not a fee, it's a deposit. You get it back when you close your trade. The reason the broker requires the deposit is that while the trade is open, there's a risk that you could lose money on the position. Assuming that this US dollar Japanese yen trade is the only position you have open in your account, you would have to maintain your account equity, which is absolute value of your trading account, of at least $1,000 at all times in order to be able to keep the trade open. If US dollar Japanese yen plummets or does drop and your trading losses causes your account equity to fall below $1,000, the broker system would automatically close out your trade to prevent further losses. This is a safety mechanism to prevent your account balance from going negative. Understanding how margin trading works is so important that we have dedicated a whole section to it later in the school. It is a must read if you don't want to blow up your account. Moving on for now. How the heck do I calculate profit or loss? So, now that you know how to calculate pip value and the leverage, let's look at how you calculate your profit or loss. So let's buy a United States dollars and sell Swiss franc. That's what trading US dollar, Swiss franc. We're doing a buy order. Remember, US dollar is represented with USD, while your Swiss franc is represented with CHF. 1. The rate you are quoted is 1.4525 slash 1.4530, which is your bid price and your ask price. Because you are buying US dollars, you will be working with the ask price, which is the higher value of 1.4530, the rate at which your traders are prepared to sell the currency to you. 2. So you buy one standard lot, which is 100,000 units at 1.4530. 3. A few hours later, the price moves to 1.4550 and you decided to close your trade. The new quote for US dollar versus Swiss franc is now 1.4550 slash 1.555. Since you initially bought to open the trade, to close the trade, you must sell in order to close the trade so you can take the bid price of 1.4550, the price that traders are prepared to buy at. The difference between the original price where you entered the usual price in which you clicked on ask was 1.4500, and now it is at 1.445, is 0.020 or 20 pips. Using our formula from before, we now have 0.001 divided by 1.4550 times 100,000 units, which now equals to $6.87 per pip. Then times 20 pips, which you have, to now give you $135.40 as your profit. Bid ask spread. Remember, when you enter or exit a trade, you are subject to the spread in the bid ask quote. When you buy a currency, we use the offer or ask price. When you sell a currency, you use the bid price. Next up, we will give you a roundup of the freshest forex lingos you've learned. So what is the spread in forex trading? Forex brokers will quote you two different prices in currency pair, the bid and the ask price. The bid is the price at which you can sell the base currency. The ask is the price at which you can buy the base currency. The difference between these two prices is known as the spread, also known as the bid-ask spread. The spread is how no commission brokers make their money. Instead of charging a separate fee for making a trade, the cost is built into the buy and sell price of the currency pair you want to trade. From a business standpoint, this makes sense. The broker provides a service and has to make money somehow. 1. They make money by selling the currency to you for what they have paid for to buy it. 2. They also make money by buying the currency from you for less than what they receive when they sell it. 3. The difference is called the spread. It's just like if you were trying to sell your old iPhone or to a store that buys used iPhones. A smartphone with only 2 red cameras, yak. In order to make a profit, you will need to buy your iPhone. You need to make a profit. It will need to buy your iPhone at a lower price than the price it sells it for. If it can sell the iPhone for $500, then if it wants to make any money, if you want to make any money, the most it can buy from you is $499. The difference of $1 is the spread. So when a broker claims zero commission or no commission, it's misleading, because while there are no separate commission fee, you still pay a commission. It's just built into the bid-ask spread. So how is the spread in forex trading measured? The spread is usually measured in pips, which is the smallest unit of the price movement of a currency pair. For most currency pair, 1 pip is equal to 0.0001. An example of a two-pip spread for US dollar. Example of a two-pip spread for Euro US dollar currency pair will be 1.1051 slash 1.1053. You can see it here. This is the calculation, and this is the value. Currency pairs involving the Japanese yen are quoted to only 2 decimal places unless they are fractional pips, then it's 3 decimal places. For example, US dollar Japanese yen will be 110.00 slash 110.04. This quote indicates a spread of 4 pips. What type of spreads are in Forex? The types of spreads that you see on a trading platform depend on the Forex broker and how they make money. There are 2 types of spread: the fixed spread and the variable spread, also known as the floating spread. So you can see this is the fixed spread. The red line is your ask price, and the blue line is the blue bid price, and you can see the blue the sky blue portion in between is your spread value. Now for variable spread, you can see as sometimes the bid and ask will be so close, sometimes they will be so far apart. Fixed spreads are usually offered by brokers that operate as a market maker or dealing desk model, while variable spreads are offered by brokers operating in non-dealing desk model. What are fixed spreads in Forex? Fixed spreads stay the same regardless of what market conditions are at any given time. In other words, whenever the market is volatile, like Kanye's mood, or quiet as a moose, the spread is not affected. It stays the same. Fixed spreads are operated by brokers that operate as a market maker or dealing desk model. Using a dealing desk, the brokers buys large positions from other liquidity providers and offer these positions in smaller sizes to traders. This means that the broker acts as a counterpart to their clients' trades. Having a dealing desk allows the forex broker to offer fixed spreads because they are able to control the prices they display to their clients. What are the advantages of trading with fixed spreads? 1. Fixed spreads have smaller capital requirements. So trading with fixed spreads offer a cheaper alternative for traders who don't have a lot of money to start trading with. Trading with fixed spreads also makes calculated transaction costs more predictable. Since spreads never change, you're always sure of what you can expect to pay when you open a trade. So what are the disadvantages of trading with fixed spreads? 1. Requotes can occur frequently when trading with fixed spreads, since pricing is coming from just one source, that's your broker. And by frequently, we mean almost as frequently as Instagram posts from Kardashian sisters. There will be times when the forex market is volatile and prices are rapidly changing. Since spreads are fixed, the broker won't be able to widen the spread to adjust for current market conditions. So if you try to enter a trade at a specific price, the broker will block the trade and ask you to accept a new price. You will be requoted with a new price. The requote message will appear on your trading platform, letting you know that the price has moved and asks you whether or not you are willing to accept that price. It's almost always a price that is worse than the one you ordered. 2. Slippage is another problem. When prices are moving fast, the broker is unable to consistently maintain a fixed spread, and the spread that you finally end up after entering a trade will be totally different from the intended entry price. Slippage is similar to when you swipe right on Tinder and agree to meet up with a hot girl or guy for coffee and realize the actual person in front of you looks nothing like the photo. So what are variable spreads in Forex? As the name suggests, variable spreads are always changing. With variable spreads, the difference between the bid and ask price of currency pairs is constantly changing. Variable spreads are offered by non-dealing desk brokers. Non-dealing desk brokers get their pricing of currency pairs from multiple liquidity providers and pass on these prices to the trader without the intervention of a dealing desk. This means they have no control over the spread, and spreads will widen or tighten based on the supply and demand of currencies and the overall market volatility. Typically, spreads widen during economic data releases as well as other periods when the liquidity in the market decreases, like during holidays and when the zombie apocalypse begins. So here is the difference between a normal spread and a widening spread. You can see a normal spread, it sticks, the pip value of 2 is always the same. For widespread, it can just increase to so much high, depends on the volatility. So when the market is more volatile, the spread will be less. When the market is less volatile, the spread will be wider. For example, you may want to buy Euro USD with a spread of 2 pips, but just when you're about to click buy, the US unemployment report is released and the spread rapidly widens to 20 pips. Oh, and spreads may also widen when Donald Trump tweets about the US dollar when he was still the president. So these are some of the quotes from Donald Trump. The United States should not be penalized because we're doing so well. Tightening now hurts all that we have done. The US should be allowed to recapture what was lost due to illegal currency manipulation and bad trade deals. Debt coming due and we're raising rates. Really? Again from Donald Trump. China, the European Union, others have been manipulating their currencies and interest rates lower, while the US is raising rates, while other dollars get stronger and stronger with each passing day, taking away our big competitive edge. As usual, not a level playing field. So, what are the advantages of trading with variable spreads? I hope my imitation of Donald Trump was not that bad. Variable spreads eliminate experiencing requotes. This is because the variation in the spread factors in changes in price due to market condition. But just because you don't get requoted doesn't mean you won't experience slippage. Trading forex with variable spreads also provides more transparent pricing, especially when you consider that having access to prices from multiple liquidity providers usually means better pricing due to competition. What are the disadvantages of trading with variable spreads? Variable spreads aren't ideal for scalpers. The widening spreads can quickly eat into your profits that the scalper makes. Variable spreads are just as bad for new traders. Spread may widen so much that when it looks like a profitable spread can widen so much that what looks like a profitable can turn into an unprofitable within a blink of an eye. So fixed versus variable spreads, which is better? The question of which is better, the question of which is a better option between fixed and variable spreads depends on the need of the trader. There are traders who may find fixed spreads better when using variable. There are traders who may find fixed spreads better than using variable spread brokers. The reverse may also be true for other traders. Generally speaking, Traders with smaller accounts and who trade less frequently will benefit from fixed spread pricing, and traders with larger accounts who trade frequently during peak market hours when spreads are the tightest will benefit from variable spreads. Traders who want fast trade execution and need to avoid requotes will want to trade with variable spreads. So spread cost and calculation. Now that you know what a spread is and the two different types of spreads, you need to know one more thing: how the spread relates to actual transaction costs. It's pretty easy to calculate, and all you need are two things: the value per pip and the number of lots you are trading. So let's look at an example. As you can see, here is a euro versus United States dollars, and our bid price, which is the sell, is 1.3562 with a pipette of 6, and our ask price, which is the buy, is a 1.3564 with a pipette of 0. For my calculations, we can see that our spread is 1.4 pips. In the quote above, you can buy euro US dollar at 1.35640 and sell euro US dollar at 1.35626. This means if you were to buy euro US dollar and then immediately close it, it will result in a loss of 1.4 pips. To figure out the total cost, you multiply the cost per pip by number of lots you are trading. So if you are trading many lot size, that is a 10,000 units, the value per pip is $1. So your transaction cost will be $1.4 to open this trade. This is how we calculated it. Your pip spread of 1.4 times your 1 mini lot size, which is $1 equals to 1 pip. So $1 times 1.4 will now give you $1.4, which is your spread cost. As you can see, let me zoom in so you can see it well and see the calculations. The pip cost is linear. This means that you will need to multiply the cost per pip by the number of lots you are trading. So if you increase your position size and your transaction cost, which is reflected in the spread, will rise as well. For example, if the spread is 1.4 pips and you're trading a 5 mini lots, then your transaction cost is now going to be $7. And here's how we derived our $7. So if you're using 1 mini lot size, you'd like to straightforward, but since you're using 5 mini lot size, you're opening 5 mini lots, now be 1.4 our pip spread times your 5 mini lot size times what a pip will cost. That's $1 per pip movement to now give you your $7 for the spread cost. Now, impress your date with Forex lingo. As in any new skill that you learn, you need to learn the linguistic or the lingo, especially if you wish to win your love's heart. You, the newbie, must know certain terms like the back of your hand before making your first trade. Some of these terms you've already learned, but it never hurts to do a little review. Major and minor currencies. The 8 most frequently traded currencies are US dollar, euro, Japanese yen, Great British pound, Swiss franc, Canadian dollar, New Zealand dollar, and Australian dollar. They are called the major currencies or the majors. They are the most liquid and most sexy. All other currencies are referred to as minor currencies. Base currency. The base currency is the first currency in any currency pair. The currency code shows how much the base currency is worth as measured against the second currency. For example, if the United States dollar is part of the Swiss franc, the rate equals to 1.6350, then 1 US dollar is worth 1.635 Swiss franc. In the forex market, the US dollar is normally considered the base currency for quotes, meaning that quotes are expressed as a unit of 1 US dollar per the other currency quoted in the pair. The primary exception of these rules are the British pound, the euro, and the Australian and New Zealand dollar. Quote currency. The quote currency is the second currency in any currency pair. This is frequently called the Pip currency, and any unrealized profit or loss is expressed in this currency. Pip. A pip is the smallest unit of price for any currency. Nearly all currency pairs consist of 5 significant digits, and most pairs have the decimal point immediately after the first digit. That is, a euro-U example equals to 1.2538. In this instance, a single pip equals the smallest change in the fourth decimal place, that is 0.0001. Therefore, if the quote currency in any pair is US dollar, then 1 pip always equals 1 divided by 100 of a cent. Notable exceptions are pairs that include the Japanese yen, where a pip equals 0.01. Pipette, 1/10 of a pip. Some brokers quote fractional pips or pipettes for added precision in quoting rates. For example, if the euro versus the US dollar move from 1.32156 to 1.32158, it moved 2 pipettes. Bid price. The bid price is the price at which the market is prepared to buy a specific currency pair in the forex market. At this price, the trader can sell the base currency. It is shown on the left side of the quotation. For example, in the quote Great British Pound US dollar, 1.8815/15, the bid price is 1.8812. This means you sell 1 British pound for 1.8812 US dollars. So let me just example this last bullet point. This 1.8812 is your bid price, while the 1.8815, that slash is the 15, that's the 12 and the 15, is your ask price. So now, ask or offer price. The ask / offer price is the price at which the market is prepared to sell a specific currency pair in the forex market. At this price, you can buy the base currency. It is shown on the right side of the quotation. Again, for the example in the quote, euro US dollar 1.2812/15, the ask price is 1.2815. This means you can buy 1 euro at 1.2815 US dollar. The ask price is also known as the offer price. Bid ask spread. The spread is the difference between the bid and the ask price. The big figure quotes is the dealer expression referring to the first few digits of an exchange rate. These digits are often omitted in the dealer quotes. For example, the US dollar Japanese yen rate might be 118.30/118.34, but will be quoted verbally without the first 3 digits as 30/34. In this example, United States dollar versus Japanese yen has a 4 pip spread. Quote convention. Exchange rates in the forex market are expressed using the following format: base currency, quote currency equals bid ask. Transaction cost. The critical characteristics of the bid ask spread is that it is also the transaction cost for a round turn trade. Round turn means a buy or sell trade and an offsetting buy or sell trade of the same size in the same currency pair. For example, in the case of the euro US dollar rate of 1.2812/15, that's /15, the transaction cost is 3 pips. The formula for calculating the transaction cost is transaction cost, which is spread, equals to ask price minus bid price. Cross currency. A cross currency is any currency pair in which neither currency is the United States dollar. These pairs exhibit erratic price movements since the trader has, in effect, initiated two US dollar trades. For example, initiating a long, which is a buy Euro Great British Pound pair, is equivalent to buying a Euro US dollar currency pair and selling a Great British Pound US dollar pair. Cross currency pairs frequently carry a higher transaction cost. Margin. When you open a new margin account with a Forex broker, you must deposit a minimum amount with that broker. The minimum varies from broker to broker and can be as low as $100 or as high as $100,000. Each time you execute a new trade, a certain percentage of the account balance in the margin account will be set aside as the initial margin requirement for the new trade. The amount is based upon the underlying currency pair, its current price, and the number of units or lots traded. The lot size always refers to the base currency. For example, let's say you open a mini account that provides a 200 to 1 leverage or 0.25% margin. Mini accounts trade mini lots. Let's say one mini lot equals $10,000. If you were to open one mini lot, instead of having to provide the full $10,000, you would just really need to provide $50, which is to get it now your 10,000 unit price times 0.5%, which is just $50. Leverage. Leverage is the ratio of the amount capital used in a transaction to the required security deposit, which is the margin. It is the ability to control large dollar amounts of a financial instrument with a relatively small amount of capital. Leverage varies dramatically with different brokers, ranging from 2 to 1 to 500 to 1. Now that you've impressed your date with your Forex lingo, how about showing them the different types of trade orders? The types of trade orders. Would you like pips with that? Okay, not the type of order. An order is an order. Order is an offer sent using your broker's trading platform to open or close a transaction. If the instructions specified by you are satisfied. Basically, the term order refers to how you will enter or exit a trade. Here, we discuss the different types of orders that can be placed in the Forex market. Be sure that you know which type of orders your broker accepts. Different brokers accept different types of Forex orders. Order types. There are some basic order types that all brokers provide, and some others that sound weird. So orders fall into two buckets. The market order, which is an order instantly executed against the price that your broker has provided, and then we have a pending order, an order to be executed at a later time at the price you specify. Here's a quick map of the different types of orders within each bucket. So market order, we have the buy and the sell. Then the pending order, we have the buy limit, the buy stop, the sell limit, and the sell stop. Now let's talk about market order. A market order is an order to buy or sell at the best available price. For example, the bid price for Euro US dollar is currently at 1.2140 and the ask price is at 1.2142. If you wanted to buy Euro US dollar at market, then it will be sold to you at the price of 1.2142. You will click buy and your trading platform will instantly execute a buy order at that hopeful exact price. If you have ever shopped Amazon, it's kind of like using that one-click ordering. You like the current price, you click once and it's yours. The only difference is that you are buying or selling one currency against another currency instead of buying a Justin Bieber CD. Just keep in mind that depending on market conditions, There may be a difference between the price you selected and the price that is finally executed or filled on your trading platform. Now, limit orders. A limit order is an order placed to either buy below the market or sell above the market at a certain price. This is an order to buy or sell once the market reaches the limit price. You place a buy limit order to buy at or below a specific price. You place a sell limit order to sell at a specific price or better. Once the market reaches the limit price, the order is triggered and executed at the limit price or better. So here is your limit price, and the current price is the blue dot. As you can see, sell limit order placed above price, and price then goes down. Buy limit order placed below price, and then price goes up. In the image above, the blue dot is the current price. Notice how the green line is below the current price. If you place a buy limit order here, in order for it to be triggered, the price will have to fall down here first. As you can see, a limit order can only be executed when the price becomes more favorable to you. Notice how the red line is above the current price. If you place a sell limit order here, in order for it to be triggered, the price will have to rise up here first. For example, US dollar is currently trading at 1.2050. You want to go short if the price reaches 1.2070. You can either sit in front of your monitor and wait for it to hit 1.2070, at which point you will click a sell market order, or you can set a sell limit order at 1.2070. Then you could walk away from your computer to attend your ballroom dancing class. If the price goes up to 1.2070, your trading platform will automatically execute a sell order at the best available price. You use this type of entry order when you believe the price will reverse upon hitting the price you specified. A limit order to buy at a price below the current market will be executed at a price equal to or less than a specified price. A limit order to sell at a price above the current market will execute a price equal to or more than the specified or the specific price. Stop entry order. A stop order stops an order from executing until price reaches a stop price. You will use a stop order when you want to buy only after price rises to the stop price, or sell only after the price falls to the stop price. A stop entry order is an order placed to buy above the market or sell below the market at a certain price. You place a buy stop order to buy at a price above the market price, and it is triggered when the market price touches or goes through the buy price price stop price. You place a sell stop order to sell when a specified price is reached. So here is your schematic of how it looks like. So you can see your sell stop. You can see the price was moving down, but you don't buy at the current market order. You set a lower price, and when the price drops to that, when the value drops to that price, it will now triggered, and the order will be executed for you. Same thing for a buy stop. When the market is going upwards, you pick a price that you believe the price will reach up to, and you believe after you hit that price to keep going upwards. You now place a buy stop order. Again, in the image above, the blue dot is the current price. Notice how the green line is above the current price. If you place a buy stop order here, in order for it to be triggered, the current price will have to continue to rise. Also, notice how the red line is below the current price. If you place a sell stop order here, in order for it to be triggered, the current price will have to continue to fall. As you can see, a stop order can only be executed when the price becomes less favorable to you. For example, Great British Pound versus the United States dollar is currently trading at 1.5050 and is heading upward. You believe that the price will continue in this direction if it hits 1.5060. You can do one of the following things to play this belief. sit in front of your computer and buy at market when it hits 1.5060, or you set a stop entry order at 1.5060. Now, stop loss order. An order to close out if the market price reaches a specific price, which may represent a loss or profit. A stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if the price goes against you. If you're in a long position, it is a stop order. It is a sell stop order. If you're in a short position, it is a buy stop order. Remember this type of order. A stop loss order remains in effect until the position is liquidated or you cancel the stop loss order. For example, you went long, that's you bought euro versus US dollar at 1.2230. To limit your maximum loss, you set a stop loss order at 1.2200. This means if you are dead wrong and the euro US dollar drops to 1.2200 instead of moving up, your trading platform would automatically execute a sell order at 1.2200, the best available price, and close out your position for a 30 pip loss EU. Stop losses are extremely useful if you don't want to sit in front of your monitor all day worried that you will lose all your money. You can simply set a stop loss order on any open position so you won't miss your basket weaving class or elephant polo game. Trailing stop. A stop loss order which is always attached to an open position and which automatically moves once profits become equal to or higher than a level you specify. A trailing stop is a type of stop loss order attached to a trade that moves as the price fluctuates. Let's say you've decided to short US dollar versus Japanese yen at 90.80 with a trailing stop of 20 pips. This means that originally your stop loss is at 91.00. If the market goes down and hits 90.60, your trailing stop will move down to 90.80 or break even. Just remember though that your stop will stay at this new price level. It will not widen if the market goes higher against you. Going back to the example, with a trailing stop of 20 pip, if US dollar hits 90.50, then your stop will move to 90.60 or lock in 20 pip profits. Your trade will remain open as long as the price does not move against you by 20 pips. Once the market price hits your trailing stop price, the market order to close your position the best available price will be sent and your position will be closed. Limit order versus stop orders. New traders often confuse limit orders with stop orders because both specify a price. Both types of order allow traders to tell their brokers at what price they are willing to trade in the future. The difference lies in the purpose of the specified price. A stop order activates an order when the market price reaches or passes a specific stop price. For example, euro versus United States dollar is trading at 1.1000. You have a stop entry order to buy at 1.1010. Once the price reaches the 1.1010, your order will be executed. But it doesn't necessarily mean that your buy order was filled at 1.10. If the market was moving fast, you might have been filled at 1.1011. Basically, your order can be filled at the stop price, worse than the stop price, or better than the stop price. It all depends on how much price is fluctuating when the market price reaches the stop price. Think of a stop price simply as a threshold for your order to execute. At what exact price that your order will be filled at depends on the market condition. A limit order can only be executed at a price equal to or better than a specified limit price. For example, euro versus United States dollar is trading at 1.1000. You have a limit entry order to buy at 1.1009. Your order will not be filled until you get filled at 1.1009 or better. Think of a limit price as a price guarantee. By setting a limit price, you are guaranteed that your order only gets executed at your limit price or better. The catch is that the market price may never reach your limit price, so your order never executes. In the previous example, Euro US dollar may only fall down to 1.009 before skyrocketing. So even though you wanted to go long Euro US dollar, the orders were never executed since since you were trying to enter a long position at a cheaper price. You watch Euro US dollar rise without you. This is the trade-off when using a limit order instead of a market order. So weird forex orders. We have the go till cancelled. A GC order remains active in the market until you decide to cancel it. Your broker will not cancel the order at any time. Therefore, it is your responsibility to remember that you have the order scheduled. We have good for the day. A GFD order remains active in the market until the end of the day. Because Forex exchange is a 24-hour market, usually means 5 p.m. EST, since that's the time the US market closes. But we recommend you double check with your broker. GFG and DTC are known as time in force orders. The time in force, or the TIF, for an order defines the length of time over which an order will continually working before it is cancelled. Think of it as a specific instruction used when placing a trade to indicate how long an order will remain active before it is executed or expires. One cancels the order, OCO. An OCO order is a combination of two entry or stop loss orders. Two orders are placed above and below the current price. When one of the orders is executed, the order is cancelled. An OCO order allows you to place two orders at the same time, but only one of the two will be executed. Let's say the price of Euro US dollar is 1.2040. You want to either buy at 1.2095 over the resistance level in anticipation of a breakout, or initiate a selling position if the price falls below 1.1985. The understanding is that if 1.2095 is reached, your market order will be triggered and the 1.1985 sell order will be automatically cancelled. One triggers the other, OTO. An OTO is the opposite of the OCO, as it only puts an order when the parent order is triggered. You set an OTO order when you want to set profit taking and stop loss levels ahead of time, even before you get into a trade. For example, you are trading United States dollar versus the Swiss franc. It's currently trading at 1.2000. You believe that once it hits 1.2100, it will reverse and head downwards, but only up to 1.1900. The problem is that you will be gone for an entire week because you have to join a basket weaving competition at the top of Mount Fuji where there is no internet. In order to catch a move while you are away, you set a sell limit at 1.200 and at the same time place the related buy limit at 1.1900, and just in case, you place a stop loss at 1.2100. As an OTO, both the buy limits and the stop loss orders will only be placed if your initial sell order at 1.2000 gets triggered. An OTO and OCO order are known as conditional orders. A conditional order is an order that includes one or more specified criteria. In conclusion, the basic forex order types, market, limit entry, stop loss, and trailing stops, are usually all that most traders ever need. To open a position, the following pending orders may be used. Buy stop, to open a long position at the price higher than the current price. Sell stop, to open a short position at the price lower than the current price. Buy limit, to open a long position at the price lower than the current price. Sell limit, to open a short position at the price higher than the current price. So here is a cheat sheet. The current price is the blue dot, remember that. So here is your neat cheat sheet. You can look at it, memorize it, pause the video and observe more. Unless you're a veteran trader, don't worry, with practice and time you will be. Don't get fancy and design a system of trading requiring a large number of forex orders sandwiched in the market at all times. This is always a trade-off when using a limit order instead of a market order. For example, if you want to buy right now, you have to pay the higher ask price, which is called a market order, as it will trade at whenever the market price is. If you press to save your money, you need to use a limit order. The problem with being patient is sometimes the price continues to go up and your limit order is never filled. If you still want to get in a trade, you have to either enter a price order or update your limit order. This now means you end up paying even more than the original ask price. Stick with the basic stop first. Make sure you fully understand and are comfortable with your broker's order entry system before executing a trade. Also, always check with your broker for specific order information and see if any rollover fees will be applied if your position is held longer than 1 day. Keep your ordering rules simple as is the best strategy. 2. Demo trade your way to success. You can open a demo account for free with most forex brokers. These pretend accounts have most of the capabilities of a real account. But why is it free? It's because the broker wants you to learn the ins and outs of their trading platform and have a good time trading without risks, so you will fall into love with them and deposit real money. The demo accounts allow you to learn about the mechanisms of forex trading and test your trading skills and processes with zero risks. Yes, that's right, zero. You should demonstrate until you develop a solid, profitable system before you even think about putting real money on the line. We repeat, you should demonstrate until you develop a solid, profitable system before even thinking about putting real money on the line. Don't lose your money declaration. Now, place your hand on your heart and say, I will demonstrate until I develop a solid, profitable system before I trade with real money. Now, touch your head with your index finger and say, I am a smart and patient forex trader. Do not open a live account until you are consistently trading profitably on a demo account. If you can't wait until you are profitable on a demo account, then there's very little chance you'll be profitable live with real money and emotions are factored in. You're probably thinking, so what I hear you saying is there is a chance then? If you're that impatient, then at least try to demo trade for at least a month. You can hold up losing all your money for a month, right? If you can't, just donate your money to your favorite charity or give it to your mama. Show how you still care. Even after reading this, you're still not going to demo trade for at least a month, since you are stubborn like that. But at least we tried. Concentrate on one major currency pair. It gets far too complicated to keep tabs on more than one currency pair when you start demo trading. Stick with one of the majors because they are the most liquid, which usually means tighter spreads and less chance of slippage. Plus, in the beginning, you need time to focus on improving your trading processes and create good habits. You also need to practice different market environments and learn how to adjust your methods and strategies as market behavior changes. You can be a winner at currency trading, but as with all other aspects of life, to take hard work, dedication, a little luck, and a whole lot of patience and good judgment. Can you get rich by trading forex? Before we go any further, we are going to be 100% with you and tell you the following before you consider trading currencies. 1. All forex traders, and we do mean all traders, lose money on some trade. 90% of traders lose money, largely due to lack of planning, training, discipline, and not having a trading edge and having poor money management rules. If you hate to lose or are a super perfectionist, you also probably have a hard time adjusting to trading because all traders lose a trade at some point or another. 2. Trading forex is not for those who have no source of income, those on low incomes, or knee deep in credit in card debt, or who can't afford to pay the electric bill or afford to eat. You should have at least 1,000 of trading capital in a mini account that you can afford to lose. Don't expect to start an account with a few $100s and expect to become a gazillionaire. The forex market is one of the most popular markets for speculation due to its enormous size, liquidity, and tendency for currencies to move in strong trends. You would think traders all over the world will make a killing, but success has been limited to a very small percentage of traders. The problem is that many traders come with the misguided hope of making a gazillion bucks, but in reality, they lack the discipline required for really learning the art of trading. Most people usually lack the discipline to stick to a diet. Most people, usually lack the discipline to stick to a diet or go to the gym 3 times a week. If you can't even do that, how do you think you're going to succeed? One of the most difficult but financially rewarding endeavors known to man or woman. Short-term trading is not for amateurs. It is rarely the path to get rich quick. You can't make gigantic profits without taking gigantic risks. A trading strategy that improves taking a massive degree of risk means suffering inconsistent trading performances and large losses. A trader who does this probably doesn't even have a trading strategy, unless you call gambling a trading strategy. Forex trading is not a get-rich-quick scheme. Forex trading is a skill that takes time to learn. Skilled traders can and do make money in this field. However, like any other occupation or career, success doesn't just happen overnight. Forex trading isn't a piece of cake, as some people would like you to believe. Think about it. If it was, everyone trading would already be millionaires. The truth is that even expert traders with years of experience still encounter periodic losses. Drill this into your head. There is no shortcut to forex trading. It takes lots and lots of practice and experience to master. There is no substitute for hard work, deliberate practice, and diligence. Practice trading on demo account until you find a method that you know inside and out and can comfortably execute objectively. Basically, find a way that works for you. At this point, we finally come to the end of our lesson 2 in our Forex beginner class. I hope you've learned enough. I know it took over an hour to learn, but please be patient, follow these videos and learn. As you can see, we have so many packages rendered for you for free, and we also have our mentorship class for you too. Please stay tuned. Contact me on any of these following platforms for questions or inquiries. Look forward to hearing from you in our next class. And please don't forget the little assignment asked of you. Thank you, thank you, thank you.